Hey, it's Paul Johnson. Thank you for taking the time to go through this VA presentation with me. I promise you, if you stay tuned into this, you will save money. You will save a lot of money, short term and long term. It will set you up for the best possible outcome. A mortgage is the largest financial transaction most people make in their entire lives. And it makes sense to take 20 or 30 minutes to really customize that and set it up in a way that helps you achieve your short and long term goals. So, I'm going to take you through a scenario right now. Now, VA is our favorite loan to do. I grew up in a military family. My dad, my grandpa, uncles, cousins, a couple of my early mentors growing up were also in the military. I learned a lot. And one thing I know for sure, you earn this eligibility. You deserve to have it set up the best possible way for you to make sure that you get every possible advantage that you've earned with your eligibility. So let's go through this scenario here. $400,000. We're going to do a couple different ones, but I want you to be able to see visually how these things break down. So 400,000 with a zero down. The VA is 100% financing. Now, if you exceed the loan limit in your county, for example, in our county, San Diego, the loan limit is $612,900. You can go higher than that, and oftentimes clients do need to go higher to get the home that they want. With the VA, there's a rough formula. It basically breaks down to 25 cents of every dollar over 612,900. So let's say you went to 712,900. That's a $100,000 difference. You would be required to put $25,000 down. So VA does go into the jumbo territory. We've had clients even do over $1 million. It's the best jumbo loan product out there. So for our example here, we're going to show the no program, zero down, 100% first loan. Now, if it's the first time you're using it, you're going to have a VA funding fee of 2.15%. If you have a disability rating of any percentage, even 10%, you get a full waiver of the funding fee. Okay? If it's a subsequent use, you've used your VA in the past, then you're looking at a 3.3% funding fee up front. This is something a lot of people aren't aware of, and it's good to know on your certificate of eligibility, it will state that you have a waiver due to the disability rating that you have. Okay, let's break down a payment. Now, interest rates, we can't show you too much here. In our one-on-one consultation, of course, we will give you specific rates from that day, but one thing I want you to know is that interest rates change every single day. This is actually a snapshot of the mortgage bond market. This Ginnie Mae here, when loans are securitized and turned into bonds, every day there's a hash mark that shows what that trading in. Green is good, red is bad. I don't want to spend too much time on this, but one reason you'll see a variety of different rates or rates change every single day, sometimes multiple times in a day. But in addition to that, there's different ways to set up your loan rate. Each one of these bond coupons represents 15 different possible rate options, and those rate options have different credits or cost associated with them. And that's one of the things we help our clients understand is, based on your situation, what's the best one for you? What's the best possible rate to choose for yourself based on your overall financial picture? Sometimes people focus on just driving the interest rate down, but there's a lot more that goes along with that. For example, if you have high interest credit card debt, and you need $10,000, $12,000 to close on your VA loan. Well, there's ways that we can negotiate credits or get lender credits or a combination of the two to eliminate that high interest debt and improve your cash flow significantly. On a VA loan, or any loan for that matter, when you put down $10,000, it generally will only change your payment around $50 to $60 a month. Let's see what it does here. $24.42, we're down to $23.93. So just like we talked about, it's in that $50 to $60 a month change range, but $10,000 on a high interest credit card could easily save you $300 a month, not to mention, on top of all of that, the interest, the significant interest you're paying. On a mortgage, it's tax deductible. So that's what we would call preferred debt. Preferred debt versus non-preferred debt. And that's one of the things that we will help you analyze. So breaking down a payment of $400,000, $2,442 a month. Another big consideration when you're purchasing is to look at what the tax savings are going to be. If you're active duty, only a portion of your income is taxable, so the tax savings won't be as much if you're employed and you're paying full taxes on all of your income. But at some point in the future, it will be, right? For most people that are in the military. So here's the thing on your tax credits. The average person saves somewhere between $300 and $600 a month. One of the things that we do is we will actually help you look up in your consultation, we'll look up the tax bracket that you're in. And then based on your tax bracket, we can help you look at estimated tax savings. Now, of course, your CPA is the person that can give you exactly what that savings is going to be. But we're going to be able to give you a real good idea if you're going to be able to pocket an extra $300 or $400 per month. And that's a huge, huge thing. So let's talk through the no-no portion of it. When you see a closing breakdown like this, typically your cash to close, that's what CTC stands for, is going to be $8,500 to $10,000. It varies month to month based on how much you have to put in for property taxes. The closing costs themselves are usually pretty static within the sale price that you're in. So, most people are assuming, okay, well, it's a zero down loan, but I have to bring in this $8,500 to $10,000 to close. That's not necessarily true. There's two different ways that can be paid for. Number one, it can be paid for by using a credit from the seller. Now, in some markets, low inventory makes it difficult to get the seller to pay $8,000, $9,000, $10,000 because they're concerned about the appraisal coming in high enough to cover that. But you can usually still get some money. A lot of times I advise people ask for $2,000, $4,000, $5,000. Somewhere in that range is a good offer to start out with. It's a nominal amount, but we could take whatever amount that they give us. Let's say in this example, they give us $4,500. Well, now we need $4,000 for closing. Now, one of the things that we talked about with interest rates is that when you adjust rates either up or down, it creates a cost or a credit. So in this example, I'm adjusting the rate up, and you can see the payment change here. Now, if you had an increase in rate around that amount, it should generate around $4,000 to $5,000 that could go towards your closing cost. And that's how you execute a VA no-no. We have the zero down on the front end. We negotiate creatively to get you closed and to get the credits that you need to cover those entire costs. One thing in addition that I like to advise clients is, hey, a mortgage payment doesn't start up right away. So if at all possible, try to close early in the month. Now, the bottom line cost might be a little bit more, but if we're having the seller and lender pay that, that's not money out of your pocket. What it does for you is it puts the payment further down. So, as an example, a lot of our clients are closing early in May. And so all those clients closing early in May, there's no payment in May, there's no payment in June, they have their first payment July 1st. So it creates a little financial momentum going into the home, and that extra cash flow could be used to, fix up the home, paint, the different odds and ends that you need going into a home. It's really important. One of the things I really hate to see is when a client purchases a home and then they've put in all this money, and a year or two later they're calling and they need to refinance because they have credit card debt that they acquired from fixing the home up. A lot of times, just by simply planning on the front end, for example, going in, if we knew we needed $10,000 or $15,000 to do the fix up or painting or remodeling that you wanted to do, and you had that in your savings account, a VA no-no would allow you to use that savings instead of a credit card to pay for all those improvements. And that's a huge, huge advantage of the VA loan over any other type of loan that's out there. So one of the things that I would like to offer is a free consultation where we can go through numbers very specific to you, using sale prices that are specific to you, breaking down tax savings that are specific to you, and answering your questions. Everyone's goals and the challenges that they may have are different. You may be looking to make something happen quickly, and we can do that. Our average loan closes in 19 to 21 days. We're very fast and very efficient. On the other hand, you may be further out. You may have some credit challenges. And a lot of folks do have credit challenges. Life happens. Tough times come to all of us. And so one of the things that we really take pride in is helping our clients get those things fixed. Maybe it's 6 months or 12 months down the road and you're just learning and getting educated about what all of your options are. Hey, that's a great time to look at where you are specifically, look at specific numbers, so the game plan that you have is based on real numbers, a real plan, a real strategy that will help you get to your goal of owning a home. Thank you for taking the time today. I look forward to connecting with you soon.